Hello everyone and welcome back to the sessions on fixed income for CFA Level 1. Now, fixed income subject had been quite lengthy and in total 19 chapters in your curriculum, and now we have landed to the last and 19th chapter titled as Mortgage-Backed Securities. So basically the sequence in which we have learned things, we have learned securitization already. So those who have not watched the securitization video, in the description box below this video I have given the link of securitization video as well. Securitization was followed by asset-backed securities, and while learning asset-backed securities we have already discussed what are mortgage-backed securities. So actually speaking, the base concept of mortgage-backed securities we have covered in multiple chapters earlier. If you can recollect, in the second chapter of your fixed income, where we have been talking about the fixed income instruments cash flow structures, there we have identified what are asset-backed securities and what are mortgage-backed securities as an introduction. When we came to chapter 17, that was securitization, we have learnt in detail what are mortgage-backed securities. In fact, in the whole securitization process, the example that I conveyed to you was the whole thing about mortgage pool, and that mortgage pool becoming asset pool, which is at the backing of the bonds issued by the SPE, and that is why the bonds issued by SPE were resembled as mortgage-backed securities. Then even in the earlier chapter, that is asset-backed securities, I have given you classification. If you can recollect, asset-backed securities could be having an asset pool which includes mortgage loan, or it may strictly exclude mortgage loans. So what is excluding mortgage loans are basically non-mortgage asset-backed securities. When there is a mortgage involved or mortgage being the primary thing, we call it mortgage-backed securities. Now, please do not expect that in this chapter again I am taking you through the basics of mortgage-backed securities. Of course, in the notes I have given you the description about, just to recollect what is mortgage-backed security, but in your explanation I don't have to cover it again, otherwise it will be too much of duplication of what we have discussed already. So let us rapidly take a recap of what is the concept of mortgage-backed securities, and then we actually look into what is the specific learning outcome statement given in your CFA curriculum, and accordingly we take it ahead. So let us first look into what is given in your notes. A mortgage-backed security, MBS, is a type of asset-backed security that is created by pooling together a large number of residential mortgage loans, that is loans given to individual borrowers to buy homes, and then packaging those loans into a tradable financial instrument. That tradable financial instrument is what we call as the mortgage-backed security, and the pool of those assets is what we call as mortgage pool. These mortgage loans serve as the collateral for the security, and the periodic payments made from the homeowners, typically in the form of monthly EMIs, become the source of cash flows for the investors in the MBS. In simple terms, when individuals repay their home loans through principal and interest, the money collected is passed through to the MBS investors. MBS are issued through a process known as securitization, in which mortgage lenders such as banks or housing finance companies sell a pool of mortgages loans sell a pool of mortgage loans to a special purpose entity. This entity, that is SPE, then issues securities to the investors and uses the cash inflows from those securities to pay the originating bank from which it has purchased the mortgage pool. The result is that the lender recovers its capital upfront, while investors receive a stream of income from the EMIs paid by homeowners over time. What makes MBS different from a typical bond is that the underlying cash flows are not fixed, they depend on payment behavior of a large number of borrowers. These payments can vary due to factors such as prepayments, defaults or refinancing activity. Hence, investors in MBS are exposed to unique risks such as prepayment risk and extension risk, which will be discussed later in detail. In essence, an MBS is a way for financial institutions to convert illiquid mortgage loans into liquid tradable securities, allowing them to manage their balance sheets more efficiently and for investors to gain exposure to a diversified pool of mortgage credit. In this whole discussion what we have just made, what was something different which we haven't discussed earlier? That was this particular paragraph. This paragraph. So, if I see what makes MBS different from a typical bond, how mortgage-backed security is different from generally what we identify as bonds. The underlying cash flows are not fixed. Now see, what is the backing for the mortgage-backed securities? The backing is the mortgage pool. In that mortgage pool, what is included? Individual mortgages which are loan assets for the SPE, which were basically assets belonging to the originator or the finance company or the bank, which are now purchased by the SPE. Now imagine from the viewpoint of a property owner, there is a possibility that a property owner may come up with a prepayment. Why a prepayment? Let me give you one simple example. Suppose I am a property owner and I have taken a mortgage loan from bank X, and bank Y is approaching me and it is suggesting me that, sir, why don't you shift your loan from bank X to us, and we will give you better deal. We will give you little flexibility as well as much better interest rates. We will give you substantial discount, or maybe we will waive off the entire processing fee. You just get this loan shifted. Now in most countries, when individuals have taken housing loans, there is no prepayment penalty in most cases. So if individuals have bought property, that is housing property, prepayment penalty doesn't exist. So what may happen? This individual would want to shift his loan from bank X to bank Y. So now what happens? Bank X, suppose it has sold its mortgage pool to an SPE, and SPE backing of this mortgage pool is issuing or has already issued mortgage-backed securities. Now one of the borrower in the mortgage pool wants to make a prepayment, because that particular individual will get the new financing from bank Y and repay the entire loan which is outstanding to bank X. Individual borrower is at an advantage in doing so, but the mortgage pool is getting suffered because unexpectedly a big lump sum amount of principal repayment has occurred. Now this is one big problem with a mortgage pool, that this kind of problem may arise. Another thing, one is you can say prepayment or defaults. Now another problem could be a default. Why a default? Basically a borrower is not able to pay EMIs on time, and therefore what cash flows were supposed to be obtained, those cash flows are not obtained on time. So that is another scenario that a default arises. And refinancing activity. Refinancing itself results generally into a prepayment. Why? Because I give you example, bank Y is refinancing the loan to the borrower, or it could be just a scenario where the bank itself is arranging for a refinance to fund that mortgage. Anyway, generally what will happen, either there will be a prepayment or there will be a default. In case of default, your expected cash flows are not coming as expected. In case of prepayment, the cash flows are coming suddenly more than expected. Both of these risks are existing in a mortgage pool, and that is what a mortgage-backed security has a big point of difference compared to ordinary bonds. So what I'll now do is I'll take you ahead with your further notes on this part, that is your mortgage-backed securities, and let me discuss with you this point of prepayment first. So here we are talking about prepayment risk in MBS. One of the most important and unique characteristics of mortgage-backed security is the exposure to prepayment risk. This arises because the underlying collateral, that is residential mortgage loans, can be paid off early by borrowers, either partially or fully, before the scheduled repayment dates. In the context of MBS, a prepayment refers to any principal repayment made by a borrower that is in excess of the scheduled amount. These prepayments can happen for several reasons. Number one, a borrower sells the home and pays off the mortgage. Number two, borrower refinances the loan at a lower interest rate or makes a partial lump sum payments, which are basically voluntary payments. Now basically, I am sure you are aware of one thing. Any borrower will also have a mindset of getting rid of their loan obligations as early as possible, because see, nobody would want to stay indebted, correct? Particularly, I'm talking about individuals who are income earning individuals. They get a different feel of relaxation when they are debt free. On the other side, corporate entities in their balance sheet, they don't mind if there are big chunk of liabilities over there, because they would want those liabilities so that they are arranging funds at actually a lower borrowing cost compared to their own funds. So they want liabilities in their balance sheet. Individuals' behaviors could be little different, and many individuals may not prefer the burden of liability on them, and they have a typical intention of getting rid of that loan liability, particularly if it is an individual with a housing mortgage loan. They don't get the feel that this is my property until the loan is paid off, right? That is where a little bit of psychological impact also comes into picture. So what happens to these individuals when they get some surplus income? Even though they may get some better returns in the financial markets by investing into some alternative investments or by investing in stocks or investing in mutual funds, they would rather want to pay off their debt, and therefore they make some lump sum big payments so that their EMIs can get off or can get reduced or can get settled quickly. So this prepayment will always be a feature, particularly in the residential mortgage-backed securities. See, there are even commercial mortgage-backed securities where also there will be prepayments, but the chances of prepayments over there are little lower as compared to the residential scenario. So a borrower may sell their property and could use the proceeds for making the loan cleared. So that is one reason for prepayment. Refinancing is another reason for prepayment. Accumulation of their savings and utilizing them to pay off a chunk of loan outstanding could be yet another reason for partial prepayment generally. So the point is what to do now. So in a large mortgage pool, it is statistically likely that some borrowers will prepay even though others will continue with regular EMIs. Why prepayments matter to MBS investors? Now, how MBS investors are going to get affected because of this prepayment? Let us try to understand that. So why prepayments matter to MBS investors? The value of an MBS depends on the expected timing of future cash flows. When prepayments happen sooner or slower than expected, it alters the cash flow timing, which in turn affects the valuation and investment returns. This gives rise to two forms of prepayment risk. One is the contraction risk and one is the extension risk. Let us try to understand each one of these one by one. Contraction risk occurs when prepayments happen faster than expected. Impact: investors receive their principal back sooner. And what is the problem? This typically happens in low interest rate environments when borrowers refinance. Investors are forced to reinvest early at lower interest rates, the MBS will not appreciate in price as much as other bonds because expected cash flows shrink. So price appreciation is limited even when rate fall. Now let me explain this point to you in detail. See what happens. We are talking about contraction risk. This is typically happening when the borrowers are making prepayments. Imagine a scenario of declining interest rate. Say a housing loan borrower has borrowed at 10% per annum interest. Now the rate prevailing in market is 8%. Why should the borrower pay 10% interest where the prevailing rate is only 8%? Borrower wants to either refinance or make some arrangement so that the interest rate gets reduced. So borrower will obviously go for refinance. If the borrower is refinancing to the existing loan, the borrower will try to repay the whole amount outstanding because the borrower is getting finance from other banks or other financial institutions. Now this prepayment has happened. Because it is a mortgage-backed securities and it has a pass-through kind of arrangement, means whatever amounts are coming from the mortgage pool may be utilized even for payment of these MBS. So MBS is also getting paid off prior to its actual maturity. Now what happens to MBS investors? They are getting money earlier than required or earlier than expected. And in a scenario where interest rates have declined in the market, correct? Don't forget, the whole thing started with a declining interest rate in the market. Now when you try to, invest that money, that is reinvest your big cash flow, the reinvestment will happen at a lower rate, where earlier your cash flows were dependent on investment made at a little higher rate. As a result, the interest of the investors get affected adversely. Now people may also perceive it this way, that when market rates decline, the bonds which are offering high coupon rates will get appreciation in value, correct? We have learnt it in all the earlier topics in bonds. It happens with bonds, but in MBS this is typically not going to happen because MBS over there is becoming more and more risky with the declining interest rate. What is making MBS more risky in this scenario? Because the MBS is having that risk of prepayment. When attached with the risk of prepayment, there is a possibility that even though interest rates are declining, the value of MBS will rise, but not that much. As a result, the value rises a little bit, but the decline in interest rate is at a higher magnitude. This could be one big problem to the MBS investors. So let us take the matter ahead. So now let us move on to the next category of risk, that is extension risk. When does it occur? When prepayments happen slower than expected. What is the impact? Investors receive their principal back later instead of earlier. What is the problem? This usually occurs in rising interest rate environments when borrowers do not refinance. So investors are stuck with lower yielding cash flows for longer. Meanwhile, discounting is done at higher rates, reducing the present value. MBS duration extends, increasing interest rate sensitivity. So basically the contraction risk, what we have read earlier, arises in the scenario when interest rates are falling. Let's take the opposite scenario where interest rate starts rising up. Now nobody would want to make prepayment, correct? The borrowers don't want to make the prepayment. And here what is happening? In the market, suppose the mortgage pool had an average interest rate of 8%, but in the market now the interest rate has risen to 10%. So nobody from that mortgage pool would want to refinance. They are happy paying fixed interest of 8%. Trouble is with the investors, that is the MBS investors. They have invested at a lower coupon rate, whereas now the prevailing interest rate in the market has risen. What happens? Discounting will happen at a higher rate, and it will substantially pull down the value of MBS. So you hold MBS, you suffer loss of low coupon, you sell MBS, you incur loss on sale. Both ways the investors are stuck. This is what we call as extension risk. So what is happening in both of these situations? Both the risks, contraction risks as well as extension risk, the interest rate is playing as the key driver. That means the main factor which is influencing these risks could be considered as interest rates. Prepayment speeds are closely tied to prevailing interest rate. When interest rate fall, refinancing increases, it results into contraction risk. When interest rate rises, refinancing slows and it results into extension risk. Thus, MBS respond asymmetrically to interest rate changes, unlike traditional bonds. So, reallocating prepayment risk through time tranching. To manage and redistribute prepayment risk, MBS structures often include tranching, particularly time tranching. In this setup, different bonds classes, that is tranches, are created with different maturity profiles. Prepayments are allocated in a sequential order. Let me explain this point to you. See, what we have understood in tranching, when mortgage-backed securities or asset-backed securities are issued in tranches, the tranches primarily reflect the credit quality. So credit quality as in you have multiple ratings, the senior debt, mezzanine debt, junior debt, which is also referred to as equity debt. This type of debt tranching will be based on the quality of the credit. What if another series of tranche is created which is not quality, that is credit quality based tranches, but time based tranches? In the time based tranches, what happens? One particular tranche will be having the MBS getting matured in just 3 years time. Another tranche where MBS will mature in 5 years time. Yet another tranche where MBS will mature in 10 years time. And then within each time tranches, there may be credit rating wise tranches, that is credit quality tranches as well. So tranches and sub tranches. Now the credit quality related tranches we have discussed. Time tranches is something important now. So let me focus only on time tranches right now. So imagine the SPE has issued bonds in 3 tranches, tranche A, tranche B, tranche C. I am not going into credit quality right now. I am focusing only on the time tranches. Tranche A is maturing in 3 years, tranche B maturing in 5 years, tranche C maturing in 10 years. Now you have issued securities which are going to mature in 3 years, 5 years and 10 years respectively. Now what happens? If you would not have followed this time tranching approach, you would have issued all the bonds which are maturing in 10 years time. That is, all MBS you would have issued in 10 years maturity period, correct? In that case, if there is a prepayment happening, you will get stuck, because how will you repay your MBS? I am talking from the viewpoint of SPE. How will you repay your MBS when it is not due right now? Instead, if time tranches are created, the early prepayments amounts which are received can be utilized to redeem or pay off the tranche A, which was having maturity of only 3 years. Then next round of next couple of years, whatever money you are gathering from prepayments, you can utilize to clear off your tranche B and so on. So time tranches could be a kind of insurance policy against this kind of prepayment risk which arises in mortgage-backed securities. So what happens to shorter maturity tranches? They receive the payments first and offer protection from extension risk. Longer maturity tranches, they absorb prepayments later and offer protection from contraction risk. Although prepayment risk is not eliminated, this is reallocated so that investors can choose tranches aligned with their risk appetite. Further, what we are going to now discuss is fundamental features of securitized residential mortgages. A residential mortgage loan is a type of loan provided to an individual to help them purchase a residential property, typically a home. This loan is secured by property itself, which serves as a collateral. If the borrower fails to repay the loan, that is defaults, the lender has legal right to take possession of the property through the process called foreclosure. This legal right to claim the property is known as the first lien, meaning the lender has primarily legal priority over the asset if the borrower defaults. Once the lender seizes the property, they can sell it to recover the unpaid loan balance, including the outstanding interest if any. Key features of residential mortgage loans: prepayment penalties and recourse versus non-recourse. Prepayment penalties. A prepayment penalty is an additional charge that a borrower may be required to pay if repay the loan's principal earlier than scheduled. Now here, let me bring forward a real life practical scenario. See, prepayment penalties definitely exist, but if you take the scenario of housing loans, as I told you earlier, most countries, their laws and their banking regulations, they prohibit the banks and finance companies to charge prepayment penalty on housing loans to individuals. Corporate entities cannot be saved from that, but individuals, in most cases, if they want to make a prepayment partially or fully, they have certain types of relaxations. So if I tell you the scenario in India, if an individual has taken a housing loan and wants a prepayment at least partially, so most banks, they offer this as an open window. Someone wants to make additional payment through additional lump sum amounts every month over and above their EMI, most welcome, no prepayment penalty. If someone wants to make the prepayment to the extent of 25% of their outstanding, again no prepayment penalty. In rare cases, when the entire prepayment is done, particularly because of refinancing, there may be a prepayment penalty imposed. Why this kind of relaxation given to individuals? See, prepayment could be even under stress. Imagine I am a housing loan borrower and I am under a financial distress that I don't have enough cash flow to pay EMIs. And in that troubled situation, I was forced to sell my property, and with that I have prepaid my loan. I wanted to get rid of that loan not for any advantage but safeguarding my own position. In that case, there is a protection to such individuals by waiving off the prepayment penalty. That is why reason why you are making a prepayment. If it is a benefit that you are inclined to which is causing that prepayment, then a prepayment penalty being charged is a still reasonable thing. That is why banking regulations in most countries, they prohibit prepayment penalty charged to housing loan borrowers. But fundamentally, that concept wise, yes, it can exist, that prepayment penalties can be charged to the housing loan borrowers. So when does this happen typically? This typically happens in a falling interest rate environment where borrowers may refinance into cheaper loans. These penalties are designed to compensate lenders for the loss of expected interest income. They help reduce prepayment risk from the lender's perspective. Common in Europe, rare in the United States. As I told you, in Indian situations for individuals, this is extremely rare scenario. Now we have recourse versus non-recourse loan. The legal recourse available to a lender in the event of default varies depending on the loan type. One could be a recourse loan and one could be a non-recourse loan. What exactly is a recourse loan? If foreclosure proceeds are not enough to cover the unpaid balance, the lender can also pursue other assets of the borrower, offers stronger protection for the lender. That is basically recourse loan. And in case of non-recourse loan, the lender can only claim the property itself if the property's value has fallen below the outstanding loan, called negative equity or underwater mortgage. The lender cannot go after borrower's other assets. So let me first explain to you what exactly is the meaning of the word recourse. Recourse means you have an alternate way to recover back your money. Recourse means an alternate course of action can be taken. Now, if there is a recourse available, that means in case the borrower is making default, you definitely can seize the property. You can, have the possession of the property. Title deeds are already with you because it's a mortgage loan. You can sell that property and recover all your outstanding, including all outstanding interest and penalties. What if the value of property that day is lower than the outstanding balance? In that case, entire property is not even sufficient to pay off the dues. Then, in case of a recourse loan, the lender need not worry because lender has attached other assets of the borrower. Means borrower has pledged their other assets. There may be some guarantors available. So somebody has taken a guarantee for the borrower that in case the borrower makes default, I will make the payment. So there is a guarantor, there is another property attached to the loan. In such cases, it's a recourse loan where the lender is more protected, more security is with the lender. In case of non-recourse loan, there is no recourse available, means the only mode of recovery could be the repayment made by the borrower. In case the borrower makes default, the property which is in the mortgage, that property stand alone, whatever you can recover out of that, that's it. No personal assets or other assets of the borrower can be attached. That is how we differentiate recourse and non-recourse loan. This difference becomes especially important during housing market downturns. Borrowers with non-recourse loan are more likely to strategically default when home value falls below loan amount, even though it affects their credit score. They may choose to walk away from the property rather than continuing paying loan on that exceeds the home value. So what is meant by a strategic default? When a borrower is intentionally, purposely making a default, means borrower was capable of making the payments, but when there is a downturn in the property value in that entire region, borrower would believe that okay fine, I don't want the property any longer because anyway the property value has fallen. The property value is lower than the amount of outstanding. Why should I hold this property? I want to get rid of this whole thing, and they would be happily moving out of the arrangement. Definitely this impacts their credit score adversely, but they are strategically deciding on this and moving out of their arrangement. And this is typically the case where the loans were non-recourse loans, means the lender, the bank or finance company do not have an alternate course available over here to recover their outstandings. Now, jurisdictional differences. In Europe, most residential mortgage loans are recourse loans offering strong protection to lenders. In the United States, the rules vary state by state. Some states allow recourse, others restrict lenders to non-recourse recover only. But in general, non-recourse loans are more common in the US residential mortgage market. Now, we come to a set of important ratios over here to understand something very, very important. These are loan to value and debt to income ratios. Let me first fundamentally explain to you what exactly these ratios mean, and then we can read and understand the content along with examples to cover up this whole matter. Loan to value. Let us say the value of a property is $400,000 and the mortgage loan that the borrower wants is $300,000. So loan to value, it's a ratio. In the numerator you will be taking the loan amount, that is $300,000 in my example. In the denominator you will be taking the value of the property, that was 400,000, and this 300,000 divided by 400,000, it will be 0.75, or you can express that in percentage as 75%. 75% is the loan to value ratio. What is the meaning of this? The meaning of this is, this loan to value ratio indicates that how much loan has been given to the borrower against the property value. So 75% of the property value has been financed by the finance company. In other words, only 25% is funded by the owner themselves. That means, what will be better? The lower the ratio, the better is the safety, correct? The lower the LTV, that is loan to value, the higher is the safety. So from safety viewpoint, that is from your security viewpoint, you should always look into that the value is substantially higher as compared to loan. That means the LTV ratio should be as low as possible. That is the significance of this first ratio, loan to value. Next is debt to income. Now, debt to income. Don't get confused with the amount of debt relating to income. How much debt obligation you have on monthly basis as EMI. That means your EMI is the monthly repayment to be made to the bank or finance company. That is the debt repayment in the form of monthly installments. So monthly debt payment or monthly EMI becomes the numerator. Suppose that is $3,000, and in the denominator it will be debt to income, means what is the pre-tax income available in the hands of the borrower. Suppose borrower's monthly pre-tax income is $10,000 and the EMI amount is $3,000. So $3,000 divided by $10,000 will give you 0.3 or 30%. What does that signify? 30% of the borrower's income is attributed to this EMI. Means borrower is having sufficient income to pay off these EMIs. If this ratio becomes higher and higher, it could be risky for the recovery, because if the borrower is spending say 80% of their income in paying EMIs, the borrower cannot survive, correct? So what proportion of the income of the borrower is utilized in EMI, that is basically debt to income ratio. So debt to income ratio is looking into the monthly EMI paying capacity in connection with the income, whereas the loan to value ratio, the first one, was observing the solvency. That means the lower the ratio, the better is the solvency. When you focus on debt to income ratio, the lower the ratio, the better is the paying capacity of the borrower. So I'm sure you understood the logical understanding about these two ratios. Then we can read and understand the formulas and take examples. Those things will be much simpler and easier once you have logically understood the significance of both the ratios. So if someone is asking you, what is the purpose of loan to value ratio? You are looking into the solvency factor, correct? On the other side, if someone is asking you the significance of debt to income ratio, it is about the monthly EMI paying capacity of the borrower. In both cases, the bank or the finance company would want these ratios to be as low as possible. So let me now take you to the details of these. So loan to value and debt to income ratios, when evaluating the default risk of a mortgage loan, two of the most important borrower level indicators used by lenders are the loan to value, that is LTV ratio, and debt to income, that is DTI ratio. These metrics help determine how likely a borrower is to repay the loan reliably over time. First, we start with the loan to value ratio, LTV ratio. This ratio measures the size of the loan relative to the market value of the property being financed. So it's simply computed as taking the loan amount divided by property value. If you want the result in percentage, you multiply by 100. If you are multiplying by 100, the indication will be in percentage. Let us take an example to understand. For example, if a borrower takes $60,000 loan to purchase a $75,000 home. The LTV is 60,000 by 75,000 into 100, that is 80%. That means, what is the significance of this ratio? It will indicate that 80% of the property is funded by loan. A lower LTV ratio implies that borrower is putting a larger equity contribution, that is down payment, which improves the lender's risk profile. That means the lender is at low risk if this ratio is low. So now, why LTV matters? Borrowers with lower LTVs have more skin in the game. They have invested more equity so that they are less likely to walk away from the property. If the borrower defaults, a lower LTV means the lender is more likely to recover the loan amount by repossessing and selling the property. Thus, a lower LTV equals to lower credit risk for the lender. We should always aim at lower LTV before lending any loans to the house owners. Now, the other ratio, debt to income ratio. The DTI ratio reflects the borrower's monthly debt obligation as a percentage of their gross monthly income before taxes, and it is calculated as monthly debt payments, that is basically the EMI amounts, which will be divided by the gross monthly income, and this gross monthly income must be the pre-tax income that you should consider. So further given, a borrower with a lower DTI ratio is seen having greater capacity to handle new debt. It indicates a smaller portion of their income is already committed to existing obligation. Why DTI matters? Lower DTI means the borrower is less financially stressed and hence less likely to default. It also shows better repayment ability and is often considered alongside LTV when underwriting the loan. Let us take jointly the impact of both of these in the upcoming example. Together, LTV and DTI form the core of mortgage credit analysis, helping lenders determine both the likelihood of default and severity of potential losses. Now, I want you all to focus on this example, a nice example. Let me explain this entire example to you. So, what is given in this example, if we read first of all, it says, a borrower is wishing to take a $300,000 mortgage on a $400,000 property. So property value is $400,000 and the mortgage loan is aimed at $300,000. So without even using calculator, you can identify that LTV has to be 75%, even that is computed over here. If the mortgage has an annual interest rate of 6%, that is repaid monthly over 25 years, and the borrower's annual pre-tax gross income is $80,000, then we calculate LTV and DTI as follows. I have already mentioned about LTV. Important thing about DTI. Now here you need to use your TVM functions for arriving at your monthly payouts in the form of EMI. So basically you have to compute EMI. So you know, we have been learning this all throughout within bonds chapter as well as in the all the QM topics, particularly the time value of money. You need to apply the TVM calculation. So first determining N will be 25 years into 12 months, so N will be 300 months in your entire loan period. I by Y, because the interest rate is to be adjusted on monthly basis. Interest rate is 6% per annum. So every month what you will have to pay is 0.5%, that is 0.5%. So I by Y you input as 0.5. Present value will be a positive amount because you are taking loan, correct? As a borrower you are taking loan. Present value will be a positive amount. It is an inflow for you. FV is 0 because the entire borrowing will be amortized over 300 EMIs. Now you compute the payment. Payment will be in the negative amounts because the borrower has to pay EMIs. So PMT result will be negative 1932.90. This calculation is no big deal for you. Important thing is the question mentions the annual pre-tax gross income. So you convert that into the monthly pre-tax gross income, dividing it by 12 months. The monthly income comes to $6,667. The idea is very simple. Against an income of $6,667 every month, the EMI stands to $1,932.90. So what is that ratio? If you compute that ratio, it is coming to approximately 29%. Means the borrower is going to utilize 29% of its income in paying these EMIs. So I'm sure you are clear with this example. And what is the matter ahead? Let me explain it to you. In the United States, residential mortgage loans are broadly categorized based on credit quality of the borrower and the loan characteristics. Two commonly used terms in this context are prime loans and subprime loans. A prime loan is a mortgage given to a borrower who demonstrates strong credit worthiness. This typically includes individuals with high credit score, a low LTV ratio indicating large down payment, and a low DTI showing manageable debt levels. So basically, any borrower giving three good indications will be classified in this category, that is a prime loan. So what are those three indicators? High credit score, lower LTV ratio and lower DTI ratio. Both of these ratios being lower and credit score being higher is a good indication of any individual to be classified as prime loan category. And therefore, prime loan, there is a possibility that the bank may charge a little low rate of interest because the bank's risk or the financial institution's risk is much lower. So a finance company funding a prime loan will be having low risk and therefore will be expecting low returns as well. On the other side, these loans are considered low risk from the lender's perspective and from the core of the high quality mortgage pool in the MBS structure. In contrast, subprime loans are issued to borrowers with lower credit ratings and often come with high LTVs and higher DTIs. So solvency wise there is a risk, repayment wise there is a risk, or cases where the lender has low priority legal claim on the property, there is second lien or junior mortgages. As a result, maybe you have already having some charge on a property and that same property you are using as a second mortgage and taking a new loan. Then because there is a subordinate charge on the property, that makes the loan much more risky. Because of the higher default risk, subprime mortgages typically carry higher interest rates and their inclusion in an MBS requires additional credit enhancement or careful structuring to attract investors. Understanding this classification is essential when analyzing the risk return profile of MBS structures, especially in differentiating prime MBS, typically agency backed, from non-agency MBS that may include subprime exposure. So now, after understanding what are the prime loans and subprime loans, we are now entering into the domain of discussion of agency and non-agency RMBS. RMBS short form for residential mortgage-backed securities. So let us understand this whole thing into as much detail as possible. So now when we are dealing with agency and non-agency RMBS, that is residential mortgage-backed securities, try understanding this. In the United States, residential mortgage-backed securities, that is RMBSs, are classified into two broad categories based on who issues or guarantees them. One is agency RMBSs and the second one is non-agency RMBSs. Agency RMBSs are securities that are either backed by US government or government sponsored enterprises, that is GSEs. GSEs are special financial institutions created by the US government to support the mortgage market, such as Fannie Mae or Freddie Mac and Ginnie Mae. Among these, only Ginnie Mae securities carry full faith and credit guarantee of US government. Fannie Mae and Freddie Mac are GSEs and they have government support. Their guarantees are not officially backed by full sovereign guarantee. They are backed only by the financial strength of the GSE itself. So this is basically the whole feature about the position in the USA with respect to the RMBSs. whether they are backed by any agency or non-backed by any agency. Backing by agency means it's a government backing. So what exactly is the concept? So here imagine an individual in the USA who is taking a housing loan, and bank is giving that housing loan on one condition, that the property is mortgaged. But if the bank wants additional assurance of the payback, say the US government, the sovereign government is giving the guarantee of payment. Maybe they could be government employees, or maybe they could have some benefit from the government in the form of government's guarantee on their repayments. In that case, the risk of the lender becomes little lower. So here there is significance of agency and non-agency mortgage-backed securities, where agency RMBSs have a little additional layer of security which non-agency RMBS do not. So let us read this further. To qualify as collateral for agency RMBS, the underlying mortgage loans must meet specific minimum underwriting standards such as maximum loan to value ratios, maximum loan size called conforming loan limits, and acceptable borrower credit characteristics. On the other hand, non-agency RMBSs are issued by private financial institutions such as commercial banks or mortgage lenders and do not carry any government or GSE guarantee. As a result, investors in non-agency RMBS are exposed to full credit risk arising from the borrower defaults. To mitigate this risk, non-agency RMBS often include credit enhancement which take the form of external insurance or third-party guarantees, letters of credit, credit tranching, or excess spread mechanism. Now if you can see basically the matter about credit tranching in terms of credit quality and excess spread mechanism, I have already explained to you in detail with the ABS chapter. Now letters of credit and basically external insurance. Most housing loans, the bank will emphasize the borrower to compulsorily take an insurance. In almost all countries, this kind of conditions exist. For example, if there is a borrower whose life is linked with that loan, in other words, if the borrower happens to not pay the loan, and before that the borrower's life is over, that borrower is no longer living, the burden of that obligation may fall upon the family members, and family members may not be capable of repayment. Knowing this, banks add one additional layer of risk by asking the borrower to take insurance policy. So now what happens? Three parties get involved over here: the borrower, the lender, and the insurance company. Now insurance company is providing insurance to the borrower, guaranteeing what? In case the borrower is not able to repay because of the death of the borrower or some kind of permanent or temporary disability of the borrower, it is the insurance company that will pay off. The obligation won't fall upon the family members of the borrower. This gives an added layer of security or added layer of safety for the lender or for the finance company or banks in case of the residential mortgages. So moving forward, non-agency RMBSs became widely known during the global financial crisis of 2007-2009, as many were backed by subprime mortgages, loans given to borrowers with poor credit histories. Despite these loans being high risk, many senior tranches of these RMBSs were rated investment grade by rating agencies. When defaults surged, even senior tranches suffered significant losses, contributing to a breakdown in trust in the securitization market. Now, I'm sure as a matter of general knowledge, each one of you is well versed with the 2007 to 2009 crisis, which was considered as global financial crisis. However, if you're not clear with that, I'll add one video along with your modules to support you to understand what was that crisis all about. It may not be part of your curriculum, but it could be important for you to know everything in detail about that crisis, because oftenly people are referring, because that became the game-changing scenario in the financial markets worldwide, because many financial institutions, they have learned bitter lessons after that crisis, and now ensuring that such crisis and such problems should not occur again. So all that happened was linked with mortgage-backed securities, and typically in case of residential home loans. So I'll be including that additional video surely for your reference. Now further given, since financial crisis, regulatory reforms and investor caution have led to sharp decline in non-agency RMBS issuance, the post-crisis environment has placed greater emphasis on loan quality, transparency and appropriate risk pricing. So basically the idea is to pull out the fact that post that crisis, the lenders have become more aware, more cautious and more alert, and now putting stringent requirements and safety related matters into picture before lending the money. Now, as I said, along with this chapter, I'll include that additional optional video for you. If you are interested, you should definitely watch it. If you already know about that crisis and don't have a need to watch, you can skip that. That is not part of your curriculum. So in this particular class, we will be putting an end to our discussion at this point. The remainder discussion will be putting into the next lecture. Thank you very much for attending this class.